All right, guys, let's take a look at your Chapter 7 homework. This is going to be problem number 1. We're looking at merchandising company and how you account for sales. And so in this problem, they want us to identify, we're going to have some new accounts and also to identify the normal balance. And just remember from your rules of debits and credits, the normal balance is always said to be the increased side. So let's kind of go through these one by one. We've got accounts receivable. Notice that's an asset, so it should have a debit balance. Sales tax payable is a liability, so therefore it's a credit balance. Sales, that's going to be a new account. That's a revenue account, so that'll have a credit balance. Sales returns and allowances, that's a debit balance. You're going to find that they're going to call that, notice it says it's a contra revenue. So I forgot to mention over here at the side, you also have to list the type of an account. So what a contra revenue does is it essentially reduces your revenue account. So therefore, excuse me, it has a debit balance. All right. Then you've got sales discounts, which is going to be just like sales returns and allowances. It's a contra revenue account. It's got a debit balance because it's going to reduce your total revenue. And then finally, you got a new one called credit card expense. It's just going to be an expense, just like your other expenses. It's going to have a debit balance. All right. That takes care of problem 1. Let's check out problem number 2. In this problem, we're going to do some basic sales recordings of some transactions. We've got 3 of them. So let's start with the first one, where they sold merchandise on account, issued sales slip. It was for 1975, terms in 30. So what that means is that we have a sale, we have a revenue, but they haven't paid us cash. They're going to pay us in 30 days. So therefore, they're going to owe us accounts receivable. So you're going to debit accounts receivable for the 1975. And then credit your sales revenue. No, we're not using fees income like you had in chapters 1 through 6. The revenue account we're using right now is simply just going to be sales. On the 15th, we have a cash sale of $29.40. So they're going to debit cash, credit your sales account. And then the last one says, finally, you received the payment on June 5th. So you simply debit cash and credit accounts receivable. All right, that takes care of problem 2. Let's look at number 3. Again, more practice, just like the other one, identical, almost identical, except on this one, note we're going to have 8% sales tax. You know, a lot of states you have to collect sales tax. So in the first one, we sold merchandise on account. It's $1,000 plus 8%, so that's going to be $80. 8% times 1,000. It's a payable. So what's going to happen is they haven't paid us yet, so we're going to put all that to accounts receivable. So you debit accounts receivable for both the sale and the tax. So notice your sales is 1,000. That tax payable, the sales tax payable, we don't get to keep that. We have to pay that back to the state. So we put that into a liability account called sales tax payable. So notice you got your 2 credits and the total debits are 1,080. On the 15th, we have a cash sale, 7,200 plus your 8% sales tax. So again, you got your sales of 7,200, your sales tax, which is again 8%. Times that 7,200. And if you're wondering again, how do they come up with that amount? Let me illustrate over to the side here. All they do is they would have taken 7,200 and multiplied that by 0.08, and that would give you your sales tax. All right. All right, so that would take care of this one. So notice the only difference between the 1st and the 15th is that on the 1st, that was a credit sale, and on the 15th, it's a cash sale. All otherwise, the account names are the same. Last one says you received a payment that was due, so you simply debit cash and then you credit accounts receivable. All righty, that was number 3. Let's check out number 4. Again, in this one, we're going to have, looks like we're going to have some sales tax and we're going to deal with some sales returns. So on the first one, we've got sold merchandise for cash, sales tax, and note the 8% is going to be the standard sales tax they're going to use in all the problems. So they're going to debit cash for both the sale plus the tax. So the sales is 3,500 and the tax payable, which is that 8%, is 280. Add those together, there's your total cash. Now on the 3rd, it says somebody had a return, $500 return, and we're going to give them a cash refund. So we have to figure out not only the cash return, but also the sales tax. So note what we do. The sales tax return, the sales return of the actual merchandise is 500, and then 8% of that is 40. We have to also give them back their sales tax. So we debit the returns and the payable for both the merchandise, and that, again, that's the 8% sales tax, and then we have to credit the cash back of $540. All right, on the 4th, again, sold merchandise on credit. This one, again, is a simple sales transaction. You've seen this one already. You debit your receivable for both the sale and the sales tax, and then note you have there's your merchandise sale, and then there's your sales tax of 8%. All right, on the 6th, we have another return, and it's $175 plus your sales tax. So we have the sales returns and allowances debit of $175. 8% of that's $14. Debit that to sales tax payable. And because this was a credit sale, we credit accounts receivable, not cash. Last one is just receiving a payment. So we're going to debit our cash and credit our accounts receivable. And you're going to have to know on this one, be careful. You have to account for that return because you had a return on the 6th of this Lisa Dang. So essentially, you would have netted the 1107. Again, let me write this one out so you can see it. You would have had, if we went to the accounts receivable account for this Lisa Dang, you would have had 1107, and then remember you would have had this return of 189. So essentially, they would be paying us the 918. That's where they would have gotten that amount right there. All right. Okay, so that would take care of, this is problem number 4. Let's check out problem 5. And this one we're going to be dealing with credit card expense. You know, businesses that use credit, they often have to pay a fee to the bank, to the credit card company. And so let's take these one at a time. So on the 2nd, we have merchandise plus sales tax. It looks like the discount fee or the bank fee is 2% at the time of sale. So you'll note that, again, we've got sale of $4,800, and note that we have sales tax payable, which again is 8%. So then that would be that 8%. And then of course you have to account for that 2% on the credit card sale at the time of sale. That's going to be, and again, let me show you this calculation off to the side here. I'll show it on my calculator on my computer. So what they would have done is they got that 4,800, and then you add in the sales tax of 5,184, and then you multiply that by by 0.02, and you'll note that that's where they get that 103.68. So note this amount right here is what they call credit card expense. So the business is charged not only for the sale, but it's the sale plus the tax. Those added together multiplied by 2% is essentially going to be the credit card expense. All right, let me close that. All right, next one is American Express. And just kind of, you can read up on how the differences between how they're accounting for different types of ways that you can do the accounting. But on this one, note the sale is $26.50. And I believe, note that I think it's going to be 3%. They tell you the rate's going to be 3%. We don't deal with the actual American Express cost until the next transaction, but essentially it's going to be 3% of these two numbers. But here's your sale, there's your 8%. So here's your basic sales transaction. And then on the 20th, it says basically they're going to take out their 3%. So you note that they're going to credit the receivable for the total amount. But, and again, I'm going to write this one out so you see the calculation. The 3%, and let me close. I don't know why that did that one. All right. The 3% would be 3% multiplied by 2862 times that 0.03. That's going to be 85.86. That's how much you're going to charge to expense. We know that essentially this cash number right there, I'm just going to write this in. That's just going to be a plug number so that your debits equal your credits. So practice this one. Again, let me know if you have any problems with the credit card problem, the credit card expense. So that's number 5. Number 6, we're going to deal with how to calculate a discount. And remember the discount, if it says 2, 10, and 30, that means if they pay within 10 days, they get a 2% discount. So $7,000 is the sale. So notice we debit AR, credit sales, and then they're going to pay us within 10 days. So the 1st through the 10th, And so what they do is they take 2% off of 7,000, which is 140. So we're going to debit this account called sales discounts. Remember, that's a contra revenue. And then the difference between the original sale and the discount is how much cash we get, which is 6,860. Again, to make the debits equal to credits. All right, let's check out number 7. Now we're going to look at the accounts receivable ledger. So you know we've got the control account, that's the one in the general ledger of 10,840. These 3 amounts right there, the 6,400, 22,260, and the 2,180, those all make up the 10,840. And then of course we've got a couple transactions here in the journal where we receive payments. Notice this one's from William Hall, and then we got a return from Garcia. So what they simply want you to do is to post these transactions and see how they affect the accounts receivable account. So you'll note down below, let me show you this. So let's go to the AR ledger, and you can see the first one is on William Hall, and here's that 640. Notice that was posted there. So that's going to update that balance. And then we got one from Garcia for 216, and that's going to update that balance. So we got 2044, 2180, and 5760. Those totals should add up to what's now in the general ledger. That should tie back to this account, which is 9984. So add those 3 accounts up and you should get that 9984. So just remember, the AR ledger is the detail and the general ledger is simply the summary. All right, that's 7. Let's check out number 8. Again, same type of problem on 8. And again, on this one, or did I, hold on, let me go back. Did I skip one? I apologize, let me check. Nope, it's the same one. All right, number 8. It looks like this is a duplicate, my apologies. So since I've already commented on this one, I think they just have one extra step. It's kind of an algorithmic type of problem they comment on that you want the AR ledger to tie back to the AR control account. All right, 9, now you do a whole bunch of transactions. They want you to record these in a journal, post your ledger, and notice they're essentially wanting you to focus on the new accounts, you know, AR, sales tax payable, sales, and so forth. So again, I'm not going to go through every one of these, but let me just kind of show you and comment. Most of these transactions are going to look almost identical except for the amounts. Notice most of these, it's the same accounts being used. The first 3 are credit sales. Don't forget to account for the sales tax. Then you got a cash sale on the 15th. You got another credit sale, and then you got a collection on the 28th. And then it looks like when you get down to the 31st, let me erase that. You've got another cash sale and then another collection. So just kind of keep track of who owes what at that point. And then of course, do all your postings. Here's your general ledger, all your accounts, make sure you post those. And then of course, they're gonna have a question about your cash receipts. All right, so take some time. This is a good practice problem, just a lot of repetition. Okay, get stuck, you can refer to this and also give me an email, I'll be glad to help you out. And then here's the last one. Again, a lot of transactions, same type of thing. You'll note there's a lot of repetition. Notice the first 3 are essentially the same. You're going to have a return on the 12th. Don't forget about that sales tax payable. And then it looks like when you get down to the 15th, we go down here. Here's another cash sale. Here's a credit sale. 2 more credit sales. You got a collection on the 18th and a collection on the 20th. You just have to keep track of who's paying you. And then you got another return on the 25th. On the 27th, looks like you have another collection. And then a couple more around that wrap this up. And then you got another credit sale and then another cash sale. So there's a lot of repetition. You're essentially using the same accounts. You just need to keep track of, you know, who owes you, what your particular customer is. And then they want you ask you a question about a percent on entertainment items. Here's all those calculations. And that's number 10 on your chapter 7 homework.